Sure. I think first and foremost it's important to note that we were very constructive on products generally, although looking at the supply side, the MR segment was heavily subscribed to when we first ventured into more asset acquisition activities. We honed in on the long-haul nature of product ton-mile demand growth, particularly as refining capacity is going to be coming online from the Arabian Gulf and also from India. It's our belief that that will begin to service a lot of the pre-existing demand in places like Europe, where the refineries simply cannot compete and will find themselves really outpaced by the more modern, efficient refineries. What this will lead to, in our view, is general constriction in the amount of supply and tonnage available to engage in product movements generally, but more specifically, those engaged in long-haul movements. There just simply has not been the same proportion of LR2s ordered than there were MRs when we started venturing into the product space. So LR2s seem to provide a disproportionate opportunity to play within the space. Separate from that has been our LR1 ventures and the same methodology there, which is really a belief in the long-haul development of product flows as they begin to service both pre-existing demand but also new demand. I think it's important to keep in mind that China will have increasing refinery capacity, and that will lead, separate apart from their own domestic consumption, more export opportunities from China to different regional activities there, some of which will be long haul as well. And then, of course, there's the widening of the Panama Canal, which is still a bit suspect on the timing, but that should encourage many, particularly traders, to try to employ the long-range tankers, particularly LR2s, and filling them out to capacity as they can go through the canal and satisfy more of the Asian demand. Sure, I think it's very difficult to talk about our asset acquisition and our asset-owning vehicles without talking about the commercial management piece. First, because it's a major part of our DNA as a company. We've been focused on the commercial management business since 2007, but separately from that, our commercial management ventures have provided us with the day-to-day information flow required to really pinpoint inflection points in the market, what tonnage we felt would be advantageous, not just now from a time charter perspective, but also longer term from an asset owning perspective. So really, all of the developments over recent months has come as a result of the strong commercial management business. Our ability to grow our commercially managed fleet from 3 vessels per month since our inception in 2007 up to now 267 vessels has been important in establishing credibility, particularly from investors outside of shipping. We needed to develop a strong reputation for commercial management, but also our ability to identify strong time charter deals before they would work with us in a deployment of capital on a regular basis. But I think there's tremendous opportunities to grow the commercial management portion of our business. The market generally remains too fragmented. More than 80% of the worldwide fleet is controlled outside the control of the top 10 ship owners. You really don't see that in many other industries. We think it's a tremendous opportunity go forward to consolidate more of the market, to work together with owners, not just to cut costs, but also to provide a better level of service to the end users, to the oil companies, to the traders. And we feel that a larger premium would result in that. I think to talk more specifically about Alpha 8, which is the latest established pool, that was simply a split from our Aframaxes that were coded within the pool to form their own pool, and that was because if you look to Q1 of 2013, there was just a disproportionate earnings between crude and clean as it related to LR2s, and more of the partners wanted that clean exposure, so we accommodated them. I think it's important to note that we're growing that pool, and with our own acquisitions of LR2s with our investors, we'll have the most sizable, really, LR2 and LR1 pools within the space. Yeah, I think that's a really interesting question. If you were to talk about crude 12 months ago, generally, not just VLCCs, there was really no investor support for crude. Everyone felt as though the declines in production in the U.S. and really the lack of importing from West Africa, or the steady decline of importing from West Africa, was really going to be the end of the crude market. We became very constructive on crude early on. We're running 21 VLCCs in our VLA pool, so we were seeing day to day how much vessels were being utilized, where the ton-mile demand was coming from, where it was declining, when and if it was. And we felt as though that the overall market was really painting the overall crude market with too broad of a brush. You had to differentiate between the segments, particularly as it related to the larger vessels, the Suezmaxes and VLCCs. And what was actually detrimenting the Suezmax market, the lack of imports from West Africa to the States as the U.S. increases their production from shale, was benefiting the VLCCs from a ton-mile demand perspective. All of that crude from West Africa was, instead of traveling to the States, was now traveling to Asia. And there's tremendous ton-mile demand growth as a result. I think the volatility we saw in Q1 of 2014 is indicative of that. Really more longer range voyages, increasing the utilization of the fleet, and really making the market conditions more volatile. I think separate from that, if you look at the supply side of the VLCCs, that makes the argument even more compelling on why VLCCs are a viable investment. And what we did in particular was a lot of data mining regarding the specific ships and how they were trading. And we found that particularly vessels over 15 years of age were becoming more and more commercially marginalized in the market, meaning that they were finding it more and more difficult to find regular fixture volume. And what that was doing was really creating a two-tier market, one for vessels over 15 years of age as it relates to the oil companies and the traders, and then one for the more modern ships. And the more modern ships able to engage in the premium voyages, loading in the AG for discharging in the U.S. Gulf or the continent, and then marrying it up with those increasing volumes that we're seeing from West Africa, but also from the Caribbean to China. So in our view, you have a situation where you have demand increasing. You have demand increasing in Asia, as it has been, but also ton-mile demand increases from the shifts in how crude is flowing. At the same time, you really have a contraction in the amount of supply availability, both from the commercial marginalization of 15-year-old ships, but also because gradually owners are working through the order book. They have not ordered substantially in these over the last few years, and things are going to continue to grow gradually tighter. Yeah, it's an interesting opportunity. I think it's those are excellent ships. Those are excellent deliveries. I think what's important on the VLCCs, particularly on one's making an incremental investment in a new building, is differentiating in the deliveries. I think really looking at 2016 at a time we feel the market will turn, and there's an early mover advantage from looking at 2016. I think people are hesitant to look at 2017 first, and for good reason. They want to see how the market develops and also what type of capacity will be available as you move later on. So I think the acquisition by General Maritime of the ships is a strong indication of an underlying belief in the VLCC market, but also a strong indication of where asset prices have moved, right? Somewhere in the area of $105 million per ship is a very strong price indication that people are betting with their wallet that the VLCs will in fact appreciate. In terms of our plans for our vessels, it may stimulate, to go back, it may stimulate people looking, particularly at that price point, at flipping vessels that they've acquired and slots that they've acquired. That's certainly not our strategy. We have a 21 vessel fleet, as I mentioned, from commercial management perspective. Our plan is to grow that fleet with these incremental new buildings and to provide our investors with a pure play, large scale VLCC vehicle that eventually we can lead a clear path to liquidity somewhere down the line, hopefully by public consumption. So we feel as though there's a lack of pure play, non-legacy VLCC portfolios, particularly on the open market and the publicly traded arena. And there's a lot of value in maintaining these slots and looking to acquire these vessels and trade them effectively through our commercial framework. And then I think in terms of incremental investments and what we plan to do, I mean, we're evaluating any and all opportunities to acquire a vessel at a well-priced point. We are still at a relatively low point in the asset market cycle. I believe there will still be appreciation in underlying asset prices, but at the same time, one has to compare new building prices at the 105 and potentially even higher now price market against what's available in the secondhand market. The secondhand market has appreciated considerably year to date because of the strong volatility we saw in the beginning of the year. So it's very difficult, in my view, to make a strong case for a second-hand vessel. However, I think opportunities will arise, particularly when the market stabilizes a bit. And I think really the last point I'd like to make on that is that there's going to be a lot of opportunities for the market to consolidate. I think most people realize that that ventures or fleet sizes of 7 vessels or 8 vessels, as we have, for example, that there's opportunities to combine offerings. And that critical mass plays a key role on how you're able to differentiate your earnings between new buildings and secondhand. So I would see certainly much more capital going to work in consolidation activities rather than buying secondhands or new buildings. But again, time will tell.